Tesla Inc. sent shockwaves through the market as its shares took a tumble following the Q3 earnings call on October 18, 2023. But what was the cause of this sudden jolt? Well, it appears that while TSLA shares were chugging along quite nicely in the aftermarket, CEO Elon Musk decided to take the conversation off the beaten path. His musings covered everything from the state of the economy to his thoughts on weight loss. These off-topic rambles left some investors scratching their heads. Resilience amid the rumble. Now, despite this sudden pullback, it's worth noting that TSLA shares have been something of an overachiever throughout the year. They've managed to outperform the Nasdaq, represented by QQQ, and the S&P 500, represented by SPY, year to date. So is this recent hiccup just a blip on the radar or something more concerning? The underlying challenges. While Tesla's Q3 2023 financial numbers didn't necessarily spell doom and gloom, there are underlying challenges that the electric vehicle, EV giant, must grapple with. One of the most significant challenges is the intensifying competition. The EV landscape is becoming increasingly crowded, with established automakers and upstart companies all vying for a piece of the pie. Tesla's once uncontested market share is shrinking, and it's facing the heat from all sides, dealing with the squeeze. Moreover, the EV market is showing signs of oversupply. With numerous players entering the game and pushing out new models, there's an increased supply of electric vehicles. While this might be excellent news for consumers, it's putting the squeeze on automakers, including Tesla. As the competition heats up and supply outpaces demand, maintaining operating margins becomes a tricky balancing act. So, is Tesla losing its shine? It's too early to write Tesla off entirely, but the recent tremors in its stock and the competitive landscape suggest that the EV king might be facing a more challenging road ahead. The electric vehicle revolution is in full swing, and the race for supremacy is only getting started. For Tesla to remain at the forefront, it must navigate these challenges and keep its innovative spirit burning brightly. Elon Musk's musings on Tesla's performance have always been an intriguing window into not just the electric vehicle (EV) industry, but also the broader global economy. When he talks, people listen. So it's no surprise that many tuned in for the Tesla Q3 2023 earnings call, hoping to gain some precious insights. However, this particular earnings call left many scratching their heads. It's fair to say that some loyal Tesla followers found it to be one of the strangest calls in recent memory. Notably, the absence of former Tesla CFO Zachary Kirkhorn was conspicuous, and the new CFO, Vaibhav Taneja, had some investors struggling to catch every word due to his accent. What stood out the most was Elon Musk's unusual preoccupation with topics well beyond the typical financials. He delved into discussions about the global economy, interest rates, and inflation. These topics, while undoubtedly important, felt somewhat out of character for Musk. It left some wondering if there might be more significant short-term risks to TSLA stock than previously considered. Now, shifting the focus from Musk's remarks to the numbers, Tesla's Q3 2023 performance wasn't as dire as the peculiar tone of the call might suggest. Total revenue reached $23.3 billion, indicating a 9% year-over-year growth. The bulk of this revenue, a substantial $19.6 billion, came from the EV segment. The company did report a net income of $1.8 billion, which was a 44% decline compared to the previous year. Earnings per share also saw a dip to 53 cents per share. When it comes to the financials, free cash flow did decrease, down by 74% year-over-year to $848 million. However, it's essential to note that Tesla's balance sheet remained robust, finishing Q3 2023 with $26.1 billion in cash. Their holdings in Bitcoin remained steady at $184 million. Tesla's strategy to remain competitive involved reducing the average cost of goods sold per EV to $37,500. This move was aimed at solidifying their position as market leaders, especially in light of several quarters of declining market share. More on that later. In terms of deliveries, Tesla is still on track to hit 1.8 million for 2023. However, Q3 2023 saw a dip in deliveries due to updates at Tesla's factory. So, while Elon Musk's performance on the earnings call might have raised eyebrows, the underlying financials aren't as bleak as one might initially think. The call may have left some room for speculation, but Tesla's core business, at least for now, seems to be holding steady. It's a reminder that when dealing with a company as innovative and dynamic as Tesla, the story extends far beyond numbers alone. While the EV side of Tesla had a rough patch due to rising interest rates, there's a brighter story in the energy storage department. Tesla Energy Storage pulled a commendable feat, marking a 90% year-over-year increase to reach 4.0 gigawatt-hours. On the flip side, Tesla Solar didn't fare as well, declining to 49 MW during the quarter. On the EV front, the supercharger network continues its rapid expansion, boasting 5,595 supercharging stations, which is a significant 31% year-over-year growth. A notable part of the sell-off story is Tesla's diminishing operating margins. They've gone through a significant drop, down to 7.6% in Q3 2023. This poses a real challenge to Tesla's bottom line as the company keeps aggressively reducing EV prices to stimulate demand. The multiple price cuts Tesla initiated in 2023 might signal a more profound issue in the EV market. It's not merely about affordability. There seems to be an oversupply of EVs in the market and a shortage of buyers. According to a survey by the Energy Policy Institute at the University of Chicago and the Associated Press Nork Center for Public Affairs Research, almost half of Americans have no intentions of buying an EV in the future. Their reasons range from thinking EVs are too costly to concerns about the practicality of charging and lingering loyalty to traditional internal combustion engine (ICE) vehicles. The problem seems to be further elucidated in a video by CNBC, which delves into the growing challenge of EV oversupply. It outlines the issue comprehensively and demonstrates that it's not just Tesla facing these hurdles, but the entire EV market. In a nutshell, Tesla's journey in the EV and energy sector is a tale of ups and downs. The energy storage sector seems to be flourishing, but the EV landscape is becoming more challenging due to economic headwinds, margin pressure, and the complex dynamics of the EV market, including potential oversupply and consumer sentiment. Tesla's ability to navigate these complexities will be key to its future success. In the domain of U.S. electric vehicles, EVs, Tesla's reign is showing signs of a downturn. Their Q3 2023 market share took a significant dip, plummeting to 50% from its Q1 2023 high of 64%. The reason? An influx of legacy automakers and emerging EV companies joined the EV party, crowding the playing field. In a bid to keep their crown, Tesla is engaged in a price battle, driving prices south and taking a hit on their profit margins. But the challenge is monumental. A new era of EVs. A new generation of electric vehicles from various companies are now in the game, offering fierce competition. Lucid, presenting the Lucid Air. Rivian, unveiling the R1T and R1S. Ford, rolling out the F-150 Lightning. Mercedes, showcasing the Mercedes EQ class. Volkswagen, introducing the Volkswagen ID class. Porsche, stepping in with the Porsche Macan and Taycan EVs. Fisker, launching the Fisker Ocean. BYD, a Chinese contender with their BYD EV line. NIO, another Chinese competitor with the NIO EV line. King, no more? Once heralded as the king of EVs, Tesla's Q3 2023 earnings call revealed chinks in their armor. Elon Musk's demeanor hinted at the image of an aging NBA star, realizing that a younger, nimbler generation of players was vying for his throne. Tesla had long been the benchmark, with the rest of the EV industry trailing behind. But today, it seems like Tesla may be struggling to keep up. The company lost one of its star players, Zachary Kirkhorn, and uncertainty looms, with questions about their capacity to maintain their aggressive 50% compound annual growth rate, CAGR goals. In essence, the EV game in the US is evolving, and Tesla, once the undisputed champion, now has to grapple with fierce contenders and new dynamics. During the Q3 2023 earnings call, Elon Musk put the spotlight on full self-drive, FSD, touting it as the future of AI. This audacious move seems aimed at recouping the revenue losses due to price cuts. In Q3 2023, Tesla slashed the FSD price to $12,000, a bold step amidst numerous short-term challenges. The rationale? FSD is on the cusp of exponential growth, and it positions Tesla as a paramount AI-first tech company. Musk is also enthusiastic about the impending launch of the Tesla Cybertruck. He labeled it the company's finest product ever. Reports indicate that as of July 21, 2023, Tesla had over 1.9 million reservations for the Cybertruck. However, Musk was less optimistic about near-term profitability, indicating that crafting and selling a revolutionary product is an arduous feat. While he hinted that Tesla could roll out 250,000 Cybertrucks by 2025, Musk's confidence in this number appeared to waver. The base version's price is expected to be around $50,000, which, if Tesla meets conservative projections, could translate into an additional $12.5 billion in revenue by 2025. Nevertheless, the initial stages of Cybertruck production might take a toll on Tesla's operating margins as they navigate the complexities of scalable, profitable production. In a brighter light, Tesla has retained its 10,725 Bitcoin holdings. With the April 2024 Bitcoin halving approximately 6 months away, experts are anticipating significant gains. For instance, BitMEX co-founder Arthur Hayes speculates Bitcoin could soar to $750,000 in the upcoming bull run. If Tesla holds onto its Bitcoin through this surge, it could potentially bolster its balance sheet by an impressive $6.4 billion in digital assets. From a technical angle, Tesla's Daily Relative Strength Index, RSI, at 31 suggests it's an attractive buy. However, a glance at the weekly RSI chart indicates that there could still be some short-term downside. Tesla's crucial support at $200 and resistance at $300 creates a trading range to monitor. Should Tesla dip below $200, the next significant support is at $150. Keep your eye on Tesla, as its journey seems poised for some twists and turns. Risk factors for Tesla shrinking. Operating margins. The operating margins, which measure a company's profitability, are important in the electric vehicle (EV) industry. Tesla's margins have been declining, which could become a problem. If this continues, Tesla might start losing money in 2024. To keep things on track, Tesla needs to lower the cost of its EVs while maintaining at least 5% operating margins. One way to do this might be by cutting out non-essential features without compromising quality. More competition. The EV market is becoming crowded, with many new EVs hitting the market. This is happening at a time when many consumers are struggling with inflation and debt, which makes it tough for them to buy new EVs. Too much supply and not enough demand can hurt Tesla's growth. Loss of CFO. Zachary Kirkhorn. The departure of CFO Zachary Kirkhorn, who had been with Tesla for 13 years, was a significant loss. He played a crucial role in the company's growth. His decision to leave might have been a warning sign that wasn't heeded. He had a Harvard MBA and contributed greatly to Tesla's success. Inflation, interest rates, and debt. Elon Musk expressed concerns about the broader economic situation. He's right. People can't buy Teslas if they're financially strained. Many people in Tesla's target market are dealing with high inflation, rising interest rates, student loans, and other financial challenges. Some experts predict that lower interest rates might come in the second half of 2024. But until then, Tesla might not see a significant uptick. Slowdown on Gigafactory Mexico. Tesla is proceeding cautiously with its Gigafactory in Mexico because of the high inflation. This might hinder Tesla's short-term growth because they want to control costs while remaining well capitalized. What's next for Tesla stock? Despite all these challenges, the writer intends to hold on to their Tesla stock and not make a panic sale. Many analysts are suggesting selling Tesla, but the writer believes that's a short-term view. Tesla still maintains strong EV production and a significant cash reserve of $26 billion. Tesla's forward PE ratio, which assesses a company's future earnings, is around 55, which the writer believes is more realistic and indicates a fair price for future earnings growth. Comparing the price-to-sales (PS) ratio with other top EV companies, Tesla appears well-positioned among Rivian, Lucid Group, and Fisker. The company also owns almost 10,000 bitcoins on its balance sheet, which could perform well with upcoming Bitcoin-related developments. Elon Musk's long tenure as CEO gives the writer confidence that if anyone can navigate Tesla through this challenging period, it's him. For those who have benefited from Tesla's remarkable 69% compound annual growth rate, CAGR, over the last 5 years, holding on to the stock is a reasonable choice. If interest rates take a positive turn, Tesla's stock might reach new heights, although the exact timing of this remains uncertain. Tesla has faced difficulties before, but has always found a way to not only survive, but come back stronger. Betting against Elon Musk and Tesla right now isn't in the writer's playbook, but rapid surges in Tesla's stock aren't expected in the near future.